What if I told you that throughout every major financial catastrophe of the last century, the 1929 Great Depression, the 1970s inflation spiral, the 2008 financial collapse, and even the COVID-19 market panic, three assets survived every single time? Not by luck, not by government intervention, but because these three positions obey a pattern built into the structure of capitalism itself. Here's the mystery. Why do the same three assets keep rising from the ashes, even when the global economy collapses? Governments fail. Banks fail. Currencies fail. Companies disappear. But these three categories march through chaos like they were designed for crisis. Tonight, we are going to uncover the origins of these crisis-proof positions, the historical moments that exposed their power, the cause and effect chain that made them survive, why modern economics still can't replace them, and how they behave in today's volatile world. By the end, you'll understand something most investors never figure out. Crises don't destroy wealth. They simply transfer it. From the unprepared to the people who know where to stand when the world catches fire. Let's go back to where the pattern begins. To understand crisis-proof assets, you must first understand one rule. Every financial system is built on confidence. When confidence breaks, everything built on it collapses. Stocks collapse. Banks collapse. Currencies collapse. Even governments collapse. The Great Depression showed it. The inflationary 1970s proved it again. 2008 exposed the financial system. COVID showed how fragile everything still is. But through all of this, one truth remained. Some investments don't need confidence to survive. They survive because their value comes from something deeper. Economists called these refuges non-correlated assets, hard value stores, anti-fragile sectors. But ordinary people knew them by a simpler name: lifeboats. To see how the three crisis-proof positions emerged, we need to examine each disaster chronologically, because each crisis revealed one part of the pattern. The year is 1929. Speculation is rampant. Banks allow customers to borrow 10-to-1, 20-to-1 leverage to buy stocks. Everyone believes the market can only go up. Then, October 24th, 1929. The market collapses in a chain reaction. The Dow loses 90% in 3 years. Thousands of banks fail. A quarter of Americans lose their jobs. Factories shut down. Farmers starve. The entire economic model implodes. And yet, one category of assets not only survived, it thrived. During the Great Depression, stock market wealth evaporated. Corporate credit dried up. Real estate collapsed. Currencies lost purchasing power. But hard assets, real, tangible, non-debt-backed commodities, rose dramatically. Why? Because they weren't tied to a bank. They weren't tied to corporate earnings. They weren't tied to government promises. Their value came from scarcity and utility, not financial engineering. This is where we discover crisis-proof asset number one. Hard, tangible assets. Gold, silver, productive farmland, industrial commodities. They formed the first anchor of crisis survival. But this was only the beginning. Fast forward to the 1970s. Oil prices triple. Supply chains choke. The US leaves the gold standard. The dollar weakens. Prices spiral out of control. Inflation hits 12%, then 14%, then nearly 20%. Savings accounts? Destroyed by inflation. Stocks? Collapsed for a decade. Adjusted for inflation, the S&P 500 delivered negative returns for years. Bonds? Crushed by rising interest rates. The middle class lost purchasing power year after year. And yet, one type of company kept growing through the chaos. Businesses that produced essential goods, had strong pricing power, generated reliable cash flows, operated in industries people cannot live without. These became known as crisis-proof asset number two, defensive cash flow companies, essential sectors. Industries like food production, utilities, energy, healthcare, infrastructure, consumer staples. While the broader market sank, these companies raised prices, maintained demand, and expanded profit margins. They survived inflation by passing costs to consumers, something luxury, tech, and speculative sectors could not do. This revealed the second piece of the pattern. In every crisis, people stop spending on what they want. but they cannot stop spending on what they need. But there was still one more asset, the one that became king after the most devastating crisis of modern times. Now we enter 2008. The housing market implodes. Banks collapse one by one. Lehman Brothers dies. $1 trillion in mortgage derivatives vaporize. The world's financial system freezes. This wasn't just a market crash. This was the collapse of trust in the entire banking system. Stocks fell. Real estate fell. Corporate bonds fell. Even safe blue-chip companies fell. The only things that survived were government bonds and assets with built-in liquidity and protection. Assets not dependent on leverage or bank stability. And that's when investors rediscovered the third crisis-proof position. Crisis-proof asset number 3, safe haven yield, cash-like instruments, treasury bills, high-grade government bonds, cash equivalents with short durations. Why did they survive? Because when the world panics, the first rule is, don't lose money. Safety becomes more valuable than profit. Liquidity becomes more valuable than growth. Access to cash becomes more valuable than assets. This is why during 2008, stocks collapsed 50%, housing collapsed, commodities collapsed, emerging markets collapsed, but short-term government debt rose in value. It wasn't exciting. It didn't produce huge returns, but it preserved wealth while everything else burned. Now the pattern was complete, but there was still one more crisis coming, and it would test these 3 assets like never before. When COVID hit in 2020, we saw global shutdown, unemployment explosions, supply chain breakdown, markets falling 30% in weeks, fear and uncertainty everywhere. The entire global economy froze. Yet again, the same 3 crisis-proof assets stood strong. 1. Hard assets. Gold reached new highs. Farmland values rose. Industrial metals surged after reopening. 2. Essential cash flow companies. Food, medicine, utilities, agriculture, logistics, household goods. These sectors barely dropped and recovered quickly. 3. Safe haven yields. U.S. Treasuries became the most demanded asset on earth during the panic. 4 crises. 4 eras of completely different causes. The same 3 survivors. The pattern wasn't random. It was structural. Now we understand what survived. But why does this pattern repeat for 100 years? To answer that, we need to explore the machinery behind every economic collapse. Every crisis in history follows the same sequence. 1. Excessive optimism. People take too much risk. Governments overspend. Investors overleverage. 2. A trigger event. A crash. A war. A virus. A rate hike. A debt default. 3. Forced liquidation. Investors sell everything to cover losses. 4. Flight to safety. People buy the assets they trust most. 5. Recovery through essentials. The economy rebuilds around real goods, services, and productive capacity. This sequence explains why the same 3 positions survive. Hard assets. Hold intrinsic value. No counterparty risk. Not dependent on financial engineering. Essential cash flow companies. Demand never drops. Stable pricing power. Supply chains tied to survival. Safe haven yield. High liquidity. Government guarantee. Negative correlation to risk assets. Together, these 3 form a crisis-proof triangle. Every other investment is outside the triangle. And when a crisis hits, everything outside burns first. Here is a painful truth. Governments do not prevent crises. They only shift the damage. During every crisis, banks are bailed out. Markets are manipulated. Currencies are printed. Interest rates are changed. But none of these protect ordinary investors holding. Speculative tech, corporate debt, luxury real estate, highly leveraged companies, high-growth startups, cryptocurrencies, emerging market stocks. Why? Because government tools fix one problem by creating another. Printing money saves banks but destroys currency value. Lowering rates saves borrowers but destroys savers. Raising rates fights inflation but destroys businesses. Debt stimulus boosts growth but creates inequality. This is why crisis-proof assets succeed. They don't rely on government policy. They survive despite it. The world is entering another high-risk era. Record global debt. Inflation spikes. Currency wars. Geopolitical conflict. Slowing economic growth. Supply chain fragmentation. Technological disruption. The conditions resemble the inflation of the 1970s, the debt danger of 2008, the uncertainty of COVID, the speculation of the 1920s. When historians analyze this era, they will find the same pattern repeating. And investors who understand the pattern today will be the ones who survive tomorrow. Now we summarize and deepen each of the three. 1. Hard, tangible assets. Protection against currency failure. Includes gold, silver, farmland, energy commodities, industrial metals. Why they survive. Not dependent on cash flow. Not dependent on debt. Not dependent on confidence. Limited supply. Globally recognized. They win in inflation, deflation, currency collapse, geopolitical risk, long-term stagnation. 2. Essential cash flow companies. Protection against economic collapse. Includes utilities, food giants, medical suppliers, energy companies, telecoms, logistics networks, consumer staples. Why they survive. Demand never collapses. Strong pricing power. Stable, regulated markets. Recurring cash flows. They win in inflation, recession, stagnation, recovery cycles. 3. Safe haven yield. Protection against market panic. Includes treasury bills, short duration bonds, high-grade sovereign debt, insured cash equivalents. Why they survive. Liquidity, guaranteed principal, negative correlation to risk assets, global demand for USD safe havens. They win in recessions, bank failures, market panics, deflation cycles. Together, these three assets create the crisis triangle. Hard value, essential value, protected value. Every other asset sits outside this triangle. That's why they fall first. 3 takeaways. 1. Crises don't destroy wealth. They reveal where real value lives. And real value lives in essential goods, hard assets, and safe havens. 2. Markets are cyclical, but crisis-proof assets are structural. No matter the cause, the survivors remain the same. 3. Wealthy families and institutions follow this rule. Individuals rarely do. That's why most people panic, and institutions buy. A warning. A new crisis cycle is forming. Nobody knows whether the next trigger will be inflation, debt, geopolitics, interest rates, banking failures, or something completely unexpected. But the survivors are already known. They haven't changed in a century. They won't change in the next century. If you wait for the crisis to begin, you're already too late. If you found this breakdown powerful, if you want more deep dive videos on crisis cycles, hidden economics, and the real forces shaping wealth, make sure to like, subscribe, and turn on notifications so you never miss an episode. And tell me in the comments, which of the 3 crisis-proof assets surprised you the most? Hard assets, essential companies, or safe haven yields? Your answer might help someone else prepare while there's still time.